Hello, everyone, and welcome to this replay of our October 6th webinar, Healthcare Sector Evolution and Outlook in the Pandemic Era. I'm Mark Salter, Executive Director for CFA Society Minnesota. Due to a technical glitch, we lost the first part of our live recording, so we've re-recorded the first couple of minutes, primarily some quick thank yous and introductions. Our first thank you goes to our speakers, Patrick Todd, CFA, and David Glickman, CFA. As seasoned analysts in the healthcare sector, Patrick and David are well qualified to take us on a deep dive into this topic and help us understand where healthcare is headed. They come to us from Harding Loevner, an asset management firm that handles global and non-US equity portfolios from their headquarters in Bridgewater, New Jersey. Quick word about Harding Loevner. Since 1989, the firm has been investing worldwide in high-quality, growing businesses based on disciplined industry research. Their philosophy is that investing in high-quality, growing businesses at reasonable prices leads over the long term to superior risk-adjusted returns. This quality growth investment philosophy has been the foundation of their strategy since the firm was founded. They invest only in businesses that are skillfully managed, financially strong, benefit from competitive advantages in their industries, and are well positioned for sustainable growth. So our thank you to Patrick and David today and to Harding Loevner. The next thank you goes to Aaron Hanson, CFA, from RBC Wealth Management. Aaron oversees U.S. due diligence within the RBC Global Manager Research Team, and we are delighted to have him as our moderator today to handle the question and answer period. Two more quick thank yous. Thank you to all of our annual sponsors, RBC, DGI, Nuveen, Thrivent Wells, and the other firms you see on your screen. They generously provide both thought leadership and financial support throughout the year so that we can make professional learning like this possible. We thank them all for their generous support. Finally, thank you to CFA Institute for providing a Zoom meetings license to our society and to CFA societies all over the world this year to help us continue to provide high quality professional learning during the global pandemic. We'll pick up the live recording a few minutes in where Patrick has just finished reviewing the agenda for today's session and is starting the overview of the healthcare sector and investment opportunities. Thank you for joining us today.
These charts take a very high level view of investing in healthcare by index weightings. Healthcare, broadly speaking, is becoming a larger and larger percentage of the main global indices. Compared with a decade ago, healthcare is up about 400 basis points in the MSCI All Country World Index, from 9% to 13%. In international, the change is even greater, and that's up about 430 basis points. And also in emerging markets, that weight is up about 330 basis points. Unchanged versus a decade ago, though, is that the largest market for investing in healthcare is the US, shown here in the bottom left chart. Emerging markets, shown here on the bottom right, have probably undergone the greatest level of change. China is now the largest weight at over 50%. 10 years ago, though, China was only 15% of the emerging market healthcare weight, and India was 45%. That change is largely due to China's continued investments in innovative biopharma and the IPOs of many new companies. India, on the other hand, has seen its generic drug companies decline in importance due to industry overcapacity and increased price pressure for generic drugs. At Harding Loevner, we invest in quality growth businesses, and we typically own these businesses for 5 years or longer. One of the proprietary quantitative tools that we use to find these businesses is something we refer to internally as a bubble chart, which is shown here on this slide. The bubbles represent a company's attractiveness, or in this case, a sector's attractiveness, based on several measures of quality, like cash flow return on investment or variability of returns, and also growth. So growth in revenues, growth in cash flow, et cetera. You can see that the median score for the healthcare sector, along with the IT and consumer staple sectors, is kind of up and to the right in the chart, indicating superior quality and growth relative to other global sectors. Healthcare companies, generally speaking, are growing faster than many other areas of the economy. And as a result, those companies are growing as a percentage of the major indices, as I mentioned on the prior slide. Now I'm going to kick it over to David, who will cover some of the trends in spending, as well as go through the payer mix. and he'll also cover a few of the COVID-19 dynamics as well, including the vaccines and the therapeutics.
Thanks, Patrick. Between the two of us, Patrick and I have about 3 decades worth of experience covering healthcare. I want to again highlight that we at Harding Loevner use the framework developed by Michael Porter to analyze industries and companies. And I'll be using this framework along with our long-term investment horizon as the lens through which we'll take a look at the discussion topics today. This slide shouldn't surprise you. The US is an outlier in terms of health expenditure compared to GDP, and it is the largest country in terms of healthcare spend. A noteworthy change in the chart on the right is that China is now number 2, having overtaken Japan in recent years. We can see that healthcare as a percentage of GDP is around 10% for many of the larger countries in the OECD, with the notable exception of the US again, which is seen on the left. Over the last 20 years, healthcare has been rising as a percentage of GDP for most countries. In other words, healthcare has been a GDP plus growth industry. An interesting outlier here is Korea, the third from the right on this slide, as their national health system expanded coverage and benefits significantly back in 2005, which has driven growth in the last 20 years. Let's take a closer look at the MSCI All-Country World Healthcare Index compared to healthcare spending. What you'll notice is that the sub-industry index weights are not at all representative of where the money spent on healthcare actually goes. I'll draw your attention to biotechnology and pharmaceuticals on the left bar chart, sitting at 15 and 41% weights respectively. Comparing that to the bar chart on the right, we can see that the sum of the two comprise only 10% of US healthcare spending. The other side of this coin is hospital care and physician services, which are just 34% and 21% of the US healthcare spending respectively. And these are just token percentages of the index. This is because on a global basis, these are payments to doctors and nurses, and many facilities globally are also owned by governments, not-for-profit institutions, physicians groups, and private equity. But in contrast, almost all of the large biopharmaceutical companies are publicly listed and are quite profitable. So when we're talking about equity exposure to healthcare in aggregate, it's not very representative of global healthcare spending. The implications of this are important. For example, if there were to be a policy in the US that dramatically reduced drug prices, but at the same time improve volumes and pricing to hospitals and services, US healthcare spending in aggregate could accelerate, but the healthcare index would likely be under pressure. We all know that in most well-developed and even many developing countries, the government is a large payer. In the developed world, the sum of the red and orange bars is very high, at about 80%. What's interesting about the orange bar, which is labeled social insurance and prepayments, is that the entities it consists of operate very differently in the US compared to other developed countries. Following the implementation of the Affordable Care Act in the US, there is officially a health insurance mandate in the US. However, employers and individuals choose these policies from a fragmented pool of insurance companies who do not pool their bargaining power or piggyback off of the bargaining power of the US federal government. Contrast this with a dynamic in a country like Germany, where so-called sickness funds are represented by the orange bar. These sickness funds pool their bargaining power and set reimbursement rates for hospital procedures and negotiate on a pooled basis with drug companies for procurement of pharmaceuticals. In other words, the US has a relatively low concentration of buyers compared to other developed countries, translating to reduced buyer power in the US, and therefore higher prices paid for healthcare goods and services. I just want to make a final point about the red bar, which is government transfer. In the US, Medicare and Medicaid do have buyer power as they get the lowest prices for drugs, surgical procedures, dialysis, and many physicians' visits compared to commercial insurance in the US. As we saw from the previous slide, not only is government spending important to healthcare, but healthcare spending is critical and is a critical and rising budget item for most governments globally. This means that it gets a lot of attention from the public, politicians, and bureaucrats. And as we near the 2020 election here in the US, even with so many other topics that have bubbled up to the top, healthcare remains as a key debate topic in this country. The outcome of the US election itself is unknown, and the positions taken by the president and the former vice president may change. However, a true Medicare for All program would consolidate the payer mix, meaning the US would have a much higher percentage of the total spending paid for by the government. That increase in buyer power would likely hurt industry returns. On the other hand, if Medicare Advantage, which is a government pay, private pay hybrid product, were to expand to lower age brackets, this is likely a more benign outcome for the industry, as it would only cause a small change in buyer power. With current events top of mind, we'll transition now to talk about COVID-19 and what the healthcare industry is doing to tackle this challenge. I'm going to start with vaccines designed to prevent infection and therapeutics, which are designed to treat COVID-19 patients. Patrick will then discuss diagnostic testing, and then an area that gets little public attention, but is a critical part of the industry being able to ultimately supply vaccines and treatments. This sub-industry, called bioprocessing, is the manufacturing equipment that will be used to make these critical vaccines and therapies. Traditional vaccine approaches have historically taken 10 to 15 years to get a product to market and include platforms you may have heard of, such as a live vaccine or an attenuated vaccine, which just means that the pathogen is inactivated. However, in the last 10 plus years, emerging vaccine companies have introduced novel platforms that can produce a vaccine candidate more quickly than established methods. So, of the 200 plus vaccine candidates globally, over half of these are from new platforms, and they include the candidates we hear about in the news every day. One drawback of these new platforms is that they are largely unproven, with only one approved product on the market utilizing one of these technologies, namely Sanofi's Flublok, which is an influenza vaccine. The historical odds of success for vaccines are about 33% from concept to approval. So if that average holds, there may be vaccines on the market in the coming years. The traditional vaccine industry is attractive, as it is a $35 billion market growing at about 9 to 10% per year. In addition to the attractive growth, the industry structure, with key factors listed on the left side, make for an industry with good profitability and long duration assets. Because vaccines are administered to otherwise healthy people, they must be very safe, and manufacturing requirements are very stringent and costly. Combined with lengthy development timelines, barriers to entry for new manufacturers have been very high. Rivalry is low, as each vaccine is a monopoly or oligopoly market. In aggregate, just 5 manufacturers control 90% of the vaccine market by value. In terms of market share, as long as the products are safe, the product with the highest efficacy captures the vast majority of market share. If that product is the first entrant, it'll tend to keep its market share. But if the first product in the market is only somewhat effective and a new product is launched with better efficacy, that new product will gain the vast majority of market share very quickly. With these dynamics, the vaccine market is relatively predictable. The outlook for vaccines being developed for SARS-CoV-2, the virus that causes COVID-19, is markedly different as it stands today. As noted in the previous slide, new platforms are being used to discover vaccine candidates, yielding many candidates in short order. Most of these platforms are designed to be manufactured in a modular fashion, so production lines can be added on as needed instead of the typical multi-$100 million investment in building scale for traditional vaccine production. As a reminder, this is still theoretical, as manufacturing is currently being done at small scale. There are also 212 vaccine candidates that have been publicly identified, which is a huge multiple relative to the handful of companies that have historically had vaccine operations. In the US, the efficacy bar is reducing infection rates by 50%. So if one vaccine launches, say in January, that is 55% effective, and there are many other new entrants with, say, 70% or greater reduction in infection rates, that product launched in January may lose all of its market share as the other entrants scale up. Given the typical oligopoly or monopoly in existing vaccine markets, buyers, including private paying governments, have little choice and absorb inflation level price increases. But given the political sensitivity of the SARS-CoV-2 vaccine and how many potential vaccines there could be, the balance of power lies with the purchaser if many vaccines make it to market. We're seeing this even today before any phase 3 data, as recent deal announcements have been at lower price points than earlier deal announcements. Similar to vaccine dynamics, there are a lot of potential entrants for therapeutics for COVID-19. As of today, Veklury, also known as remdesivir, is approved and it is helpful. The standard of care also includes dexamethasone, which is a cheap generic steroid. Investors have been focused on antibodies, including the most advanced candidates from Lilly and Regeneron, as similar approaches yielded good results in Ebola. Patients who are critically ill need therapies as well, in addition to dexamethasone. Sorry. There are many anecdotes floating around in the media in this area, but there's no well-designed study showing positive results leading to an approved product yet. The last challenge for the biopharmaceutical industry may prove to be the hardest and longest. There are studies and media articles citing lingering lung illness in patients who have recovered from being critically ill with COVID-19. Today, we know very little about the pathology, the frequency of occurrence, and even less about how to treat these conditions. As the pandemic wears on, the industry will direct resources to developing therapies for these patients with lingering ailments. Now, I'm going to turn it back to Patrick, who will begin a discussion about testing.
Thanks, David. So testing is vital to maintaining control over this virus, and bigger picture, there's no question the revenue opportunity is huge. When the first tests were approved in early March, many of which are shown here, the stock prices of some of these companies moved around quite a bit. The reality, though, was that being first to market was never indicative of the revenue opportunity. The most important determinant of revenue potential was the ability to scale manufacturing. The large incumbents here, like Thermo Fisher, Abbott, Roche, Danaher, among others, have the necessary access to capital and manufacturing expertise. And as we've seen in their second quarter results, and what we'll see in the third quarter results that are coming out shortly, these incumbents have captured the lion's share of the revenue opportunity. Abbott, as an example, with 3 approved tests, reported $600 million in incremental revenue in the second quarter, and they've seemed to bless a forecast for roughly $2 to $2.5 billion in revenue for the full year. The only constraint really is their capacity, which they are obviously working to increase further. And then a couple of weeks ago, Abbott received approval for another test called Bioprocessing Now, which is similar to a pregnancy test and does not need a machine, though will still need a confirmatory molecular test. Bioprocessing Now, I estimate, could add another $1 billion in incremental revenue for 2020. Another good example here is Thermo Fisher, which just had their analyst day, virtual analyst day, of course. The company now estimates that the full year revenue contribution from COVID-19 will be $4.5 billion, of which $3 billion will come in the second half of this year. Here we see an estimate for the testing in the US and the corresponding revenue impact for test suppliers, labs, and managed care. While these look like really big numbers, it's kind of easy to see how we can get there. Through the end of the summer, the US had already conducted over 700 million tests cumulatively since the start of the pandemic. A good case study for testing is Cornell University, which welcomed students back at the beginning of September. Their testing program contains 3 components. There's arrival testing, testing for cause, and the third is surveillance testing. And it's that last component, the surveillance testing, that really drives up the numbers of tests. Each undergrad is being tested twice per week, while grad students and staff are being tested once per week. And then based on their 2019 enrollment numbers and the staffing levels, I calculated they're administering almost 30 to 40,000 tests per month. And that's just for one relatively small school in upstate New York. Another good example comes from one of my good friends who's a head coach at a Big Ten sports program. Since school started this fall, he and his student athletes have already been tested 10 times each in just a month. And that's over 700 tests just for this one collegiate sports program. Here we see some confirmation of the testing market opportunity. So through late summer, the US has conducted the most tests, followed by India and then the UK. And you can see here that testing volumes are still growing in many markets, not just the US. And what we also see is that in countries where cases have declined, like Switzerland, for example, testing rates have remained elevated. In our opinion, given the low efficacy bar for a successful vaccine and the likelihood of that wide dissemination of any approved vaccines will take time, testing should remain elevated through at least the end of next year. So it's clear that diagnostics is a beneficiary of COVID-19. Another perhaps less obvious beneficiary, as David mentioned, is an area called bioprocessing, or the manufacturing equipment and consumables used to make vaccines and therapies. This slide shows an overview of the processes used to make biologics. This workflow is highly complex, and it's also heavily regulated by FDA and other international agencies. Each of these various steps has a huge impact on the quality and performance of the end product. And because of that regulation from governments and the manufacturing complexity, once a drug is approved, companies are usually very hesitant to switch suppliers. So in other words, bioprocessing has high switching costs, but it's also it's a highly consolidated industry. Here we see the companies in that industry. And if you look to the right, you can see it's the same companies in each product area. As David mentioned in his remarks, there are a huge number of vaccine candidates being worked on right now, over 200. But if these companies want to scale up production, they are forced to use just one of these few suppliers. So in other words, the buyer concentration versus the firm concentration in this industry is clearly in favor of the select group of companies. This observation hasn't been lost on investors, though. Shares of Germany-based Sartorius, which is really the only pure play company here, have more than doubled year to date. Healthcare is a large growth sector, but it's not without its caveats. Specifically, healthcare has concentrated buyers, and that power manifests itself in significant price pressure. I do lots of calls with our institutional clients, and I'm often asked for my opinion on which of these vaccines is going to win. The answer is we don't know. With all the candidates that David highlighted, it seems obvious to us that several vaccines will eventually be approved. The prices for those vaccines, however, will likely come under significant pressure from very strong buyers. What we do know for certain is that these vaccine and therapeutic developers need to invest in manufacturing capacity. And to scale up those processes, these fragmented developers need to buy equipment and consumables from a very concentrated supplier base. And even with an approved vaccine or vaccines, we expect demand for diagnostic testing to remain robust. The vaccine efficacy bar is low enough, and the surveillance testing will remain a key component of managing COVID-19. That concludes what David and I prepared. Thanks again for the opportunity to speak with you all today. I guess, Aaron, we can now open up questions.
Yes, great. And as a reminder, just submit any questions you might have through the chat function. And maybe I'll kick it off here, guys. Talking about the vaccines, how do you see, I guess specifically outside of the U.S. or even outside of the U.S. and Europe, how do you see the market for vaccines evolving? So maybe it's mostly emerging markets, or how do you see that dynamic playing out?
Thank you for the question. In terms of emerging markets, they have not secured the supply that we've seen in developed markets. I mean, we've seen announcements coming out of the US and various countries in Europe, Japan as well, where they've been able to secure initial vaccine supplies from manufacturers, obviously with the caveat of if approved. And emerging markets have not been positioned to do so. What's been going on, however, is that there are organizations, primarily through UNICEF, and this is how this market for vaccines currently operates, that work to procure vaccines at very low prices for emerging and frontier countries. Bill and Melinda Gates are active in funding these, as well as other countries globally. There is one company, the Serum Institute of India, that is actually the largest volume vaccine supplier in the world. And what they do is produce low-cost, older vaccines and supply countries. Biggest customer, India, obviously, and then other emerging and frontier countries. They have signed a number of deals with some of the innovative companies out of the US and Europe that they'll then work on supplying for them at a lag from what developed markets would get. So yeah, emerging markets, it should come at a materially lower price point and at a lag.
All right, great. Here's another question that came in here. What do the valuations for the main COVID-19 companies look like? In addition, what are your top picks amongst this peer group?
Well, it's easy. They're stretched. So I think that, I mean, everyone's seen, the stock prices of companies like Moderna and others. In terms of which companies our top picks, we, as a firm, we focus on companies that have durable cash flows and have a history of demonstrating good returns on investment. So we actually have a very strong preference for the companies that, the diagnostic companies, but also the suppliers. And in our fund, our global fund, and not to pitch the fund here, but we own Thermo Fisher and we also own Abbott. But if you look at a lot of the biotechs that are pursuing this, we do not own any of those and have not made investments, and it's highly unlikely that we will. But again, I mean, the companies, we also own Lonza, which is manufacturing the potential vaccine for Moderna in international, also in global fund.
What I would say with the vaccine candidates is that the small companies that we hear about in the news, like Moderna, BioNTech, they don't meet our investment criteria at this point in time. And those have garnered the bulk of the market attention and valuation. As I said, there's likely to be a lot of buyer power exerted on these companies, and that pricing is likely to fall over time. And a lot less credit has been given for the established larger scale companies that are really into vaccines currently, but haven't been given much, if any, credit by the market, including companies like Sanofi and GSK and Merck. Have received little attention, but might only be 6 or 9 months behind the first entrants, and they might come in with much larger scale if they are ultimately successful.
Okay, thank you. This one is another question that came in. It's more of a general question about the industry as a whole. How do you see how do the long-term drug prices, or how do you feel they'll be impacted by election results?
David, you want to take that one? I can chime in.
So it's as I said in our presentation, it's not easy to forecast an outcome with respect to this election specifically. Both candidates have said that they want to lower drug prices. However, the president has had a number of executive orders come out since he's been president, and they have had little effect on drug prices. The vice president was vice president for the prior 8 years with little effect on drug prices. To really cause a material change in drug prices, I think you need a material change in the system to change the buyer power dynamics. As I talked about, with the exception of what we see in Medicare and Medicaid, the buyers are quite fragmented, and they don't have that much of an incentive to really push on drug prices because they ultimately pass along a lot of those rising costs to their members. And what we really need to kind of consolidate that buyer power and materially change the system is a material change in the system. You need something kind of even more dramatic than what we saw with the Affordable Care Act to cause material change here. And it's very difficult to do, and it's difficult to know if either candidate is capable of that, and they would need Congress as well to go along with it. So real change isn't easy.
Yeah, I would just add too that there's a structural issue with the way the laws are written currently, in that of all the parts of Medicare. So A, B, C, D. D is the most recent, which is the drug benefit. Even though there's that drug benefit, the Medicare does not have the ability to directly negotiate drug prices. So we need to get overhauled completely. And if you look at the proposals, I mean, again, as David mentioned, that Trump's been in office for over 3 years now, and Biden was there for 8 years, and nothing material happened. There are some things like reference pricing and other things, but again, it's not. I don't really see much changing without a huge overhaul of the system.
Okay. This next one related to, I guess, the vaccine and maybe the process around it. Maybe a part of this might be a little tricky to answer, but I'll throw it out there. So maybe your thoughts, if you have any, around some of the, I guess, political pressures impacting the vaccine process itself. Do you have a current estimate when you believe the first vaccine will be widely available? And do you currently believe the waterfall will be for access, I think, to different groups, but kind of I would interpret that maybe to be how quickly would it be available to a wide majority of the population?
I would, that without getting too political on it, I mean, there was definitely concern, or has been concern about, from a lot of people that this vaccine would get pushed through to kind of help the election. I mean, we won't, beat around the bush on that one. I was very encouraged by, the drug companies releasing, statements saying that they're going to, go through all the regular steps. And one of the issues really is that if you did rush through something, then, folks question that, and then we don't get, wide adoption of any vaccine. So I think that it makes sense to, follow the common processes to get this thing approved. And David, do you have anything you want to add on the rest of the question?
Yes, I would agree with that. These companies want to be in it for the long haul, and even these emerging technologies, they're trying to apply to some other areas of vaccines. So it is very hard and takes a long time to build trust and confidence in a process and a system and the establishment of vaccines, but it can be very easy to destroy that confidence. And companies that are, whether they're established companies or new companies, really want and need consumers to feel confident and comfortable and get through the process in the right way. And that's why they put out those statements. Regarding dissemination, I mean, it's tough to know. The first step is that we need positive phase 3 data from one or more of the companies. It seems as it stands right now that Pfizer, BioNTech have edged into the lead a little bit. They might have data at the end of this month. And then we'll see when, if or when there'll be emergency use authorization, how long that would take, potentially followed by Moderna and then some others. Again, if they're positive phase 3 data, it will take some time to scale up and distribute, and you're going to have a lot of public awareness, public push for it. And for those early supplies, there are supplies that are guaranteed to Europe and Japan as well. Yes, there could be some rationing, so to speak, in the early stages, but it's difficult to know. But just please be aware that there are steps in this process, not to just jump, okay, widespread dissemination. First, let's get good phase 3 data. Let's see approval. These are, manufacturing of these is new and hasn't been done at scale before. Maybe there are hiccups that are not forecastable at this time. So there are a lot of steps to get to large scale dissemination.
All right, we have another one here, maybe moving a little bit away from the vaccine questions. What subsectors of healthcare do you believe currently offer the most attractiveness based on growth and valuations? And what trends are the largest drivers of this or these opportunity sets?
Maybe I'll kick that off, or start with that. Certainly, without a doubt, in terms of valuations, biopharma trades at a significant discount to my areas of coverage. So, tools, med tech, anything to do with diagnostics have all completely re-rated over the last several years, and that gap is actually very, very wide. So, I think from a just pure valuation standpoint, it looks like biopharma is more attractive. Growth areas are, overall, it's not just within the U.S., but emerging markets. The U.S. is really benefiting from, developed markets are really benefiting from, increased aging of the population, and as you get older, you need more and more. You get more cancer, and we have a bad lifestyle. Then within emerging markets, the real growth drivers there is just, increasing GDP per capita and that having access to care. We, generally favor companies that are benefiting from both of those trends and have really big moats around their individual business. But I would say, from my standpoint as a PM, where I'm looking more so right now is definitely within biopharma, because I think that the valuations of many of the non-biopharma assets are very, very stretched. David, do you have any comments?
Yes, Patrick, I agree with Patrick completely on the valuation. What I would say with growth, some of the larger biopharma companies, if you look out in just a 5-year time frame, growth looks quite subdued. A number of the big ones have large patent expiries coming, both in biotech and pharma, and a number of these companies need to do a bit more work to fill up their pipelines and convince investors that they are going to be able to mitigate that shortfall and grow after those patent expiries. And as it stands now, with the valuation disparity, investors are not that convinced in aggregate of the ability of these companies to be able to do that successfully. So that's my understanding and my view of the reason for that gap.
Okay, thank you. Question I had going back early in the presentation, you had a slide that showed the opportunity sets, and although emerging markets, which was pretty small percentage-wise, globally, China, within that, China certainly was growing, seemingly growing pretty rapidly. What is that opportunity set within China, within healthcare, and how are you guys looking at that?
So I'll take that one first, and then David can chime in. So within China, there are quite a few startups and a couple more established pharmaceutical companies. A lot of these companies have a mix of selling, generic drugs, but also kind of investing in innovative drugs, patent protected drugs. So we do own a bunch of these in emerging markets funds, and we also, we have 2 Chinese analysts to cover pretty much all of these companies. The interesting thing about China, I think, as opposed to developed markets, is that the Chinese are much more, inclined to, do a lot of outsourcing from the get-go, right? So a lot of these startup companies are using companies like WuXi AppTec, WuXi Biologics, to completely outsource their entire, to even outsource some of their early stage stuff, take the product through development. So, there's a lot of capital floating around over there, a lot of good scientists, like a lot of, developed market trained PhDs that went back home. And then, obviously China has a lot of great homegrown talent there. So there's a lot of stuff that's going to be coming out over, the next 5 to 10 years that's pretty exciting. And it was not just within pharma, but all aspects of healthcare. And actually, that's why we, have spent the time and have researched a lot of these companies and own a lot of them in our emerging markets fund.
So I, at a prior firm, worked in Hong Kong and went there in 2010. And the largest Chinese companies were companies like Sinopharm, which is a drug distributor, Sino Biopharm, which is a generic drug company. And I remember asking a lot of companies, why is your drug going to get approval? Of course, they wouldn't show any of the data, and they would just basically come back and say, we have a good relationship with the regulator. That has changed completely. So the Chinese FDA basically had copied the approval process from the US FDA, but didn't implement it the way we do here at all. That changed midway through this past decade, and the Chinese regulatory body joined up with that of the developed world, and global companies can file for approval in China using the same set of data, as long as they include some Chinese patients, and it will get approved, not because they have a good relationship with the regulator, but because the data are of high quality and robust and merit approval. And this significant change, coupled with, on the reimbursement side, they are more willing to reimburse new and innovative drugs and have cut prices of generic drugs, exercising their buyer power, has caused a massive inflow of financial capital and human capital into this business, into this industry in China, and enabled it to grow. So drug development does take time. So these companies are often starting with more of kind of Me Too drugs, but we're seeing some signs now that there's kind of more innovation coming, and we expect more to come. So it's a very interesting time.
Yeah, I would just add that, I mean, to that point, that the results you used to see out of, Chinese clinical trials, 10 years ago, 15 years ago, it's just not believable, right? For developed market companies or investors. And that has completely changed over the years. And when you talk with companies, are you willing to work in China? Do you want to work in China? They all say yes now, but 10 years ago, there's a high level of skepticism. And I think that David brought up a very good point there with that CFDA change that kind of accelerated this development.
Interesting. Another question here, and I'm not exactly sure, maybe it'll make more sense to you guys. Does the healthcare sector indicate a standalone mandate should be pursued in a client's SAA? And what are the driving factors for or against the standalone mandate?
I'm not sure I'm prepared or equipped to answer that question. I guess it would probably would come from looking at the diversification and the client's other holdings. Most of our strategy, I'll just add that as I mentioned earlier, healthcare and IT, as we're growth investors, we're looking at those are pretty much across all our funds. Those are the largest overweights to the sector. But I'm not, I probably would say no. I mean, I don't think that it should be a standalone strategic asset allocator or strategic standalone mandate.
Okay, here's another one. Earlier in the presentation, you mentioned an increase in Japan's pricing pressures, allowing China to become number 2. Do you see these pricing pressures in Japan as a more permanent result? And then 2, maybe we touched on this a little bit previously in the China question. Are there areas within China that are interesting to look at? But I think you already touched on that.
Yeah, David's actually definitely answered the Japan question.
So with Japan, it was interesting. So they always had buyer power because it's a national system, and they just negotiate price directly with the drug manufacturer. But they were terrible at exercising that buyer power. So what would happen is that even after drugs had lost patent protection, they had these really long tails in Japan where they were maybe only declining like 10, 15% per year. And the multinational companies and Japanese pharmaceutical companies were just living off of this because the government wasn't pushing down on these prices. And that changed a number of years ago, and the government thought, okay, why are we doing this? We don't have to, and let's push generics. Let's have the public gain trust in the generic system that these drugs are actually the same as the branded drug, and incentivize the pharmacists distributing these as well. And so they did that quite successfully. That has caused the growth of Japan over the years to decelerate. Japan also has a system of, it was in the past, price cuts every other year, where it was just a calculation based off of discounts in the channel, which averaged kind of 5 to 7%. And they would then take that as a price cut every other year. They've moved that to every year. So, but they kind of split the difference, but on average, it's a bit more pressure than it had been in the past. So the key is in understanding that buyer power the Japanese government, and they can just, if they're based on their budget pressures, they can just exert that power more easily than can be exercised here in a country like the US, where it's very fragmented. China has a lot of buyer power as well, but they've exerted it, and they've actually exerted it kind of similarly. So China was overpaying for these generic drugs as well. They've decided to launch a lot of national tenders for them. Pricing has often fallen kind of 90+% on some of these. And they said, oh, okay, well, now we're going to cover new and innovative drugs, and we're going to cover them at pretty reasonable prices to get wide adoption and to get these companies to distribute them in our country. So that's been the change that has taken place in China. And the net result is that China has grown much faster than Japan over the last kind of 10, 20 years.
Okay, great. Thank you. And I think looks like that's answered all the questions that have come in, unless there's any last minute questions here. But thank you, everyone, for submitting the questions. So if there were some good questions in there. Certainly thank you, Patrick and David, for your insights today. Any sort of final closing comments from you guys?
No, I mean, just to say thanks very much. It was a lot of fun talking with you all. Some very good questions. Yeah, just if you have any further questions and any follow-ups you want to ask us, I put up Jay Green's email address there and contact info if there are any follow-ups.
Thank you. Great questions.
Yeah, that's great. Again, thank you. Thank you, everyone, for participating today. We do appreciate it. And again, thank you to Patrick and David for their time, and for Harding Loevner for coming on and joining us today. So thanks, everyone, and have a great day.
And Aaron, thank you very much for moderating, and thanks again to all of our sponsors, and we'll see you on another webinar soon. Take care, everybody.
Thanks, Mark.